Morning everyone. In this video, I will show you how to use FXswap to convert surplus cash in one currency into the currency of our funding requirement. Before we proceed with our example, we need to understand that FX swaps have involved two legs. One is the near leg and one is the far leg. In the near leg, we exchange one currency for another, and in the far leg, we reverse the exchange of the currencies. FX swaps are priced by reference to the far leg. In order to calculate the FX forward rate that we are going to use in our FX swap calculation, we need a spot rate and forward points. A spot rate and the forward point will be quoted to us. If you see forward points ascending, you will add them to the spot rate. If you see forward point descending, you will deduct them from the spot rate to arrive at the FX forward rate that we are going to use in our FX swap calculation. Bank buy base currency low, bank sell base currency high. We are given one currency pair US dollar HKD. As you can see that US dollar is mentioned first, therefore US is the base currency and HKD is the variable currency. In our example of US dollar and CHF, US dollar is the base currency and CHF is a variable currency. We are told that we have 20 million CHF surplus that will last 1 month when we will need 20 million CHF to fund our outgoing payment. We have currently shortfall in US dollar. Therefore, we are going to convert surplus 20 million CHF into US dollar. For the purpose, we are given quote spot rate and the forward point, 1 month forward point. You can see the forward point 35 to 38 is ascending. Therefore, we are going to add them to the spot rate. You can see the spot rate is 1.1633. We are going to add the forward point 0035 and to arrive at the forward rate of 1.1668. Likewise, on the other side of the spot rate, we are going to add the forward point to arrive at 1.1686. Now, which rate are we going to use? As we have discussed that the forward swap are priced by reference to the far leg, and in the far leg we are buying back CHF 20 million to fund our outgoing. If we are buying CHF back, it means we are selling US dollar. If we are selling US dollar, it means the bank is buying US dollar. And US dollar is a base currency and bank buy base low. Therefore, the rate that we are going to use is the lowest one out of these two, which is 1.1668. Now, you can see that 1.1668 is made of spot element and the forward point. In order to convert 20 million surplus CHF in near leg, we are going to divide 20 million CHF by the spot element, which is 1.1633. When you divide 20 million surplus CHF by 1.1633, you get US dollar 17.19. So we have sold 20 million CHF and we have bought US dollar 17.19 million. In the far leg, we are buying back the CHF and we are selling US dollar. Therefore, 20 million CHF you will divide by 1 month forward rate, which is 1.1668. When you divide 20 million CHF by 1.1668, you arrive at US dollar 17.14 million. We have sold dollars 17.14 million. Now if you look at the US dollar that we bought in the near leg and the US dollar we sold in the far leg, the difference between them is 51 0.57k, which represent the interest rate differential between US dollar and CHF. You can see how easy it is to use FXswap to convert surplus cash in one currency into the currency in which we need funding. I hope you will find it easy to now use FXswap in your studies or in your jobs. Let me know if you have understood this concept well. If you have any question, do let me know, please.